In this video, I'll be presenting to you my analysis of JPMorgan Chase Stock. I talk about some of the intricacies of the banking industry and why analyzing these companies is a little bit more difficult than most. I also give my thoughts on their 2020 Quarter 1 results, so stick around to watch the video. Before we jump into it, I want to give a quick channel update. So in the M1 Finance portfolio that I created for this channel, we've deposited $1,500, and we're actually doing pretty well on our positions right now, given the circumstances. Also, the channel has surpassed 100 subscribers, and by the time I release this, it could be close to 115. So thank you to everyone who has subscribed to the channel. It really means a lot, and I look forward to producing some great content for you guys moving forward. Also, you guys really seem to enjoy the last video that I put out on Boeing. It's really taken off, and thanks to you guys since it was a suggestion by one of the subscribers. Speaking of subscriber recommendations, I had a little poll on a pinned comment where you could vote on the stocks that you guys wanted to see for the next analyzed video. And the winner of that vote is Starbucks, which has been voted on by Friendly Friend Guy, Tristan Taylor, and Wazy112143. So if you guys wanted to see that video, make sure to subscribe to the channel and hit the reminder bell so you don't miss it. And with that said, let's talk about our first financial stocks that we've analyzed on this channel, JPMorgan Chase. As somebody who works in the financial services industry, I understand that most people don't exactly understand how banks make money, including myself about 6 months ago. So to break it down, banks generate income from two main sources: interest spread income and non-interest income. An interest spread is the difference between the interest rate that the bank charges to their borrower and the cost of the money to the bank to borrow that money. So for instance, if I can borrow money from my friend and they will only charge me 2%, but my neighbor wants to borrow money from me and they're willing to pay me 5% interest, my net interest spread is 3%. So if my neighbor borrows $100 from me for a year, I will, as the bank in this situation, make $3. Now this doesn't sound like much, but when banks are lending billions and trillions of dollars, this adds up to a lot of money. Banks also make money off non-interest income in the forms of fees, including deposit and transaction fees, insufficient fund fees, annual fees, monthly account service charges, inactivity fees, check and bank deposit slip fees, and so on. Also, any bank that issues credit cards also get to charge a penalty fees for late payments or transaction fees for processing payments. Now, JPMorgan Chase is considered by many to be the most successful bank in the world. Banks are an interesting part of the economy, and like many banks, JPMorgan Chase became the powerhouse that they are today by acquiring a lot of very small banks. They've also been part of some of the most impactful business transactions in history by becoming the primary financier of U.S. railroads in the 1890s and playing an integral role in the upstart of major companies like AT&T, GE, and U.S. Steel. In 2000, the company cemented themselves as one of the most dominant banks in the world when JP Morgan merged with the Chase Manhattan Company and renamed the company JPMorgan Chase & Co. To really contextualize the strength of JPMorgan Chase, they are the largest commercial bank in the United States by far, with $2.3 trillion in total assets, while the next largest bank, Bank of America, has only $1.8 trillion. They're headquartered in New York, where Jamie Dimon, one of the top 5 most influential CEOs of the last decade, in my opinion, leads the company. Currently, the stock price is about $95 per share, which is over 30% lower than their all-time high that they experienced in January. JP Morgan did release their Q1 earnings about a week ago, which we will be talking about towards the end of the video, but this was not received well by the market, and in the following days, the stock price fell by almost 10%. However, on Friday, the stock jumped by almost 9%, but then again, most banks experienced major jumps, and the stock market in general seemed to do pretty well. At the current prices, this makes the company worth about $290 billion, which is about 1.5 times their tangible net book value of $180 billion. And if you compare their stock performance over the last 3 months with other large banks in the industry, like Bank of America, Citigroup, Goldman Sachs, Morgan Stanley, and Wells Fargo, you can see that they've held up better during this coronavirus than most. Now, usually I enjoy picking up stocks after they've fallen a lot, as evidenced by my Simon Property Group and Toll Brothers acquisition on this channel. So why would an investor choose to seemingly pay more for JPMorgan Chase stocks than other banks right now? Well, there are a lot of factors that lead investors to believe that JPMorgan Chase is a safer investment than the rest of these banks, like their size, their balance sheet strength, and their proven management team. JPMorgan Chase started paying a dividend to its shareholders back in 1997. Well, back then it was still JP Morgan because they hadn't had that big merger yet. In this time, they grew their dividend consistently, except for during the Great Recession of 2008-2009 when they had to cut their dividend. At this point, JP Morgan, along with just about every financial institution, cut their dividend because of what the industry was facing. However, during the 10 years following that, JPMorgan Chase has grown their dividend payments by 20% every year, and in 2019, they paid out more than double the amount per share than they did in 2008 before the cut. Currently, the stock yields slightly above 4% of current stock prices, which right now is slightly lower than most banking stocks because I've seen many in the 5 to 6% range. However, this is due mostly to the fairly conservative payout ratio of JPMorgan Chase of just under 40%. This means that if the company in 2020 makes half of what they did in 2019, they would still be able to maintain their dividend and have money left over at the end of the year. Now, as I mentioned earlier, JPMorgan Chase released their 2020 first quarter results this past week, and there are definitely a few main points that need to be discussed from their report. JP Morgan, along with most other banks, are being flooded with requests for additional funds because their customers are struggling right now, with many not even able to operate. JP Morgan Chase has been busy processing the Payroll Protection Program loans through the SBA. This was part of the stimulus package that was passed by the U.S. government and basically allows the companies to take out up to 8 weeks of their payroll costs in the form of a low interest rate loan. However, the main selling point of this loan is that if the borrowers follow some rules set by the government, like actually using the funds to pay their employees and making required payments, many of these loans will be forgiven by the government in the future. So if the businesses follow the rules, these loans can be essentially or very cheap money. JPMorgan Chase dealt with 300,000 loans with a total value of $36 billion, which is about 10% of the money allocated from the federal government. Not only is it good for JP Morgan because they're basically risk-free loans when backed by the government, they also get to solidify their relationship with their customer because they were able to help them when they needed it. The next thing that needs to be talked about is the reserve management. All banks have to reserve a portion of their outstanding loans, which means they basically aren't allowed to loan that money out, and it needs to stay within the business's cash. This percentage fluctuates, but essentially the greater the risk that a loan has, the company has to reserve a greater percentage of that loan. This is a balancing game for these banks because with higher risk, you can charge higher interest rates. However, holding on to more cash eats into these profits because it's a lost opportunity for more interest income. The reason that I'm discussing this now is because profits in Q1 were hurt very badly because JP Morgan Chase incurred a large credit cost expense because they increased this reserve. For some context, their credit cost in Q1 of 2020 is over 5 times higher than their cost in Q1 of 2019, and this is 100% because of this reserve increase. This is something that all banks will have to do in the near future, and if things get worse, they will continue. However, I think for the time being, this isn't really something to worry about because they're not necessarily losing money, they're just planning to lose money based on current situations. With all this said, I think that the financials industry, in general, looks pretty attractive because they've been beaten down so much. I know I mentioned in previous videos that this crisis right now, it's not the same as the Great Recession, because this is a health issue that's having effects on financial institutions and the economy. However, back in 2008-2009, that was an issue with the financial institutions themselves, and the economy was a little broken. Because of JP Morgan Chase's dominance in the industry, their current valuation, their conservative dividend management, and the information released in their Q1 earnings call, I will be purchasing $250 worth of JP Morgan stock on Monday when the markets open. In the comments below, I pinned one of my comments. Here you can vote for the company that you guys want to see in the future, so make sure your voice is heard and subscribe so when the company you voted for wins, you won't miss the video that you voted for.